have you talked about this, the 2024 early stage startup cheat
I
sheet?
haven't talked about this thing. No, I haven't talked about this
No.
thing at all yet. So,
Oh, cool. Well,
so
let me do this. Let's see if maybe this will screw. It all gets recorded separately anyway, so I think it'll actually work out okay. But just as a shared point of, so we know what we're talking about together.
sweet.
So I guess just right off the bat, you want to just walk through kind of one,
Yeah.
I guess maybe I guess the best context for everybody is where is this data coming from? And I think
Yeah.
everyone knows, I think everyone who would listen to this knows what Carta is, but I think it's important and interesting to give a breadth of, because we'll get into that a little bit. Because like YC, for example, is coming up. And that's, there's different pockets of a big
Their
market.
numbers, their numbers will not.
Those markets are not the same as these numbers.
They will not look like
I've
this.
found.
This
Yeah,
is
yeah. So
the
give me a sense
non-YC
of the
division.
sample. Yeah, give me a sense of the sample.
Yeah. So, in general, Carta is now 43,000 startups strong on the cap table platform, of which about 11,000 are actually pre-seed. So
Oh, wow.
quite a few that
Yeah.
have not raised any priced equity yet.
Okay.
And then they could, Carta launched the product that we have for pre-seed founders. If you raise less than $1 million, you get Carta for free. The data itself, though, so like there's two ways to look at this. Is one, you just take like a time period and you say, okay, for Q4 2023, what were the averages or what were the medians, et cetera.
Yeah.
Because it's not the end of the quarter yet, but there's been like a pretty decent amount of change so far in 2024. I just said, I'm going to take the most recent 75 rounds for each one of these stages on Carta, and we'll just show those as a cohort. So each one of these bands is 75 rounds.
Got it. So
Why did
yeah.
I pick 75? It's mostly because that like fit into 2024-ish. Like there's a lot more angel rounds than there are Series A's. Like,
Yeah, but you need a common denominator across
totally. Yeah.
the bands.
Exactly.
Cool. And so
Exactly.
how are you like differentiating? Like, is it within Carta it'll be like tagged an angel round or a pre-seed round, or is it defined by the under 500K?
Yeah, so this is like the big question that comes out of whenever we put this kind of data out is like, what do you call the safe stuff?
Mm-hmm.
Anything on safes, anything priced equity, it's easy. It's like seed, Series A, there's extensions, there's bridges, it's simple.
Yeah.
Or at least it's simple because you have the documents.
Yeah. It's legally called that, right? It's like legally like the written, Series A.
It's written in the contract. It's written in the term sheet that this is a Series A, or it is if it's a bridge, it'll often be written like Series A - preferred to whatever. But it's in the same named series as the one before it, so it's a bridge round.
Yeah.
The safe stuff, all the safes are the same. The safes are just the safe document. Now, some of them have side letters, but most of them are just safes. And you don't have to put any of that stuff in there. And it's just like one fundraise. So how do we split it up? The way that we've done it is we have to do this in some sort of quantitative way, even though I know there are a lot of investors who look at this and say, yeah, it's useful, but I actually think about pre-seed based on like traction from the company. Like how much ARR do they have? Are they pre-product? That kind of stuff. I don't have access to that data. So we just show it based on amount raised. Mm-hmm. And we show it based on the amount raised in a specific valuation cap. Meaning if you are raising 250K at a $4 or $5 million valuation cap, that is one round. And if the same company ends up later on raising another $500,000 at a $10 million valuation cap, that is a separate round.
Yeah, okay, got it.
Yeah.
You're taking the safe cap as the value. So that's how which is, I think, how most people think of it, right? Like it ends up being.
Most of the time, right? Yeah. And it's not, and to the graphic, like it's not as though every company goes through all of these stages, right?
Yeah.
Some companies do an angel and then they skip all the way to a priced round. Yeah. Some companies don't do an angel round. They actually start with a little bit of a bigger fundraise. Like it's kind of all over the place. But what I do think is special about the data that we have access to is we see safes and convertible notes. I don't think anyone else in the US ecosystem sees that. AngelList maybe, but most like PitchBook, Crunchbase,
Yeah,
etc.
because there's no legal filings.
There's no legal filing.
You have
It's
to be
just a
on
safe.
platform to see that and that's a classic thing in the some of the like the data tools that are available or the class. I was just talking to an investor the other day about because we all get pitched PitchBook, right? Like everyone's had a phone call with a friend of a friend who's working at PitchBook now who hits you up like,
Probably
hey,
had like more than one phone call. Yeah, exactly.
you're a VC, like do you need this? And I had a guy recently who was saying like, okay, well, let's look up my fund. Like I do pre-seed and seed. Like let's see how many investments I made, and because it's based off of legal filings, right? So AngelList and you guys would be the only with considerable because you also need enough volume to make it. Like if you're an upstart and there's other there are other like cap table providers.
You can run safes through Mercury or whatever.
Yeah.
But if a safe happens and it impacts the cap, we will know about it.
Yeah.
So like we might not know about it in the moment. We know about most of them in the moment. I think it's to not be too humble about it. I think it's the best database of safes and convertible notes anywhere in the world.
Yeah. No,
I'm pretty sure about that actually.
I think that's fair.
Yeah. We had $4 billion invested into pre-seed safes last year.
And the bigger that's crazy.
That's wild.
I gotta what does that compare? I gotta because there's another graph or another chart that you guys have that puts out like total money.
Yeah.
Invested, and do you know what penetration like of the pre-seed world? That's gotta be a decent amount.
It's a large chunk of it. Yeah. The way that we've talked about it in the past in general on Carta is that it's something like 50 to 55% of VC-backed companies. Now, pre-seed's different because there's a lot of companies that will get on Carta and they'll raise on a safe and then it won't go anywhere. And are those venture-backed? I mean, I guess depending on who the investor was.
Yeah.
But so that's a little bit of a tricky definition, but we think it's a very meaningful percentage of the total market. Yeah.
Got it. Okay, well, cool. Well, let's look at the actual kind of numbers of it. What would be if you had to put a high level takeaway on it? Like, I mean, obviously everyone's like looking at the numbers and can see and can read like the general of it. When I end up looking at it, and I get asked this by friends of like, oh, if I'm raising, before my seed and I've always had this thought in my head of, and I forget where I read it. I think I read it in some YC stuff at some point of like, by the time you close out your seed, you don't want to have sold more than 20% of the company, around 20%. Like you get to like 25 because, I was literally just listening to the Sam Lesson thing with the Aaron Torenberg, where they talk about the factory line of VC, which I'm actually kind of referring to here, right? Where you want to,
definitely,
if you sell 20%, you leave enough room for other people to stack on top, and it kind of when people say a clean cap table, that's kind of what they're talking about. So in this situation though, and looking at these numbers, it looks like in that before the price round, like around 10% is going to get give me some like kind of high level of when you look at it within the context of what we're talking about.
I think you hit on the key point, which is actually the most important figure in these data is almost always the dilution, not exactly what was raised and for the val cap. Those are like the dilution is the outcome of those other two metrics, and it's the most important one to me. So it's how much of your business you're giving up. So because this is just post-money safes, we can say, we use the word implied dilution for safes, but when you raise a price round, the safe investors will get this amount of the company. And because it's post-money, they're guaranteed that percentage. It's not variable the way that it is in pre-money safes. So all of those like data points add up to, so the very simple example of if you raise $1 million on a 10 million cap, you gave away or you sold 10% of your business. Pretty standard stuff. The sort of, factory line, Sam Lesson stuff of venture comes into play here because a lot of what founders hear is when you exit your Series A, you want to own 50% or more of the company. Like you want to maintain majority ownership through the Series A. That's what many founders are being told. Is that true and possible? It definitely is true for a lot of founders. It's not as true for some. And the reason being is there's just a lot more fundraising happening on these safes. People are doing 2, 3, 4 safe rounds, getting a little bit of money in, raising the valuation cap a little bit more money, another raised valuation cap, and that is adding up. And I don't if there was one backlash that's coming against the safe, I think it's because people are going to look around and say, we used it because it was convenient and cheap, and it's great for that reason,
Yeah.
but it also can lead to you giving up more of your company than you think, and then you get into discussions with these investors, and they say, you don't own enough of this business. Like, it's already, the cap is already very tight for us to come in and expect all of the money that you're going to need to raise overall. So it's not like it's a bad thing. It's just we're in a different world when it comes to like the pre-seed fundraising in general.
Yeah, got it. And I think as I kind of look at the numbers too, right, where you look at the angel round pre-seed stuff, like definitely smaller, but that seed on safes or price seed being kind of interchangeable, right? There's people that do price seeds, there's people that do seeds on safes. Both of those numbers, right, we're seeing like around the 20%, maybe 50% lower. Maybe there could be arguments about why that would be the case. And then that sets you up for, like, again, that factory line kind of version of like, okay, I sold 20% at seed. I sold, maybe if I went a bunch of safes, right? Like if you add up all the safes in the top, kind of those above the price round, like in the graphic, you're gonna be around 20%. And then you're gonna get to the A, you're gonna sell another 20%, and you're still gonna own 60, and everyone's healthy, and we're all kind of in a. That's like, again, the kind of cookie cutter way.
Exactly. That's like the factory settings version. Obviously, this doesn't take into account the options that you're going to set aside for employees. So there's that, and that's always a sticking point and all that kind of stuff. But did you think the seed on safes and seed, like if I had said, so the seed on safes definition for us was anything between $1 million and $2.5 million raised. But we could have very easily said, that's pretty low for a seed round for if you're doing it priced. So maybe we should have done 2 to 3 or $3.5 million. If we did that, the numbers line up really closely. Like the median valuation cap is right on 12 to 13, and the cash raise is pretty close, and the dilution is pretty close. So I think in that way, the market is functioning pretty logically.
Yeah.
Like it shouldn't really matter whether or not you do it on safes or you do it as a priced.
Yeah, that's what I was gonna. You kind of preempted what I was gonna get into. Like, oh, maybe if you're, which I don't know, maybe like if I think about who's doing seeds on safes and who's doing price seeds going to probably, because it says legal work involved, it's just a little bit, it's a more grown-up transaction
for sure.
See, safes are, you download the docs, you sign something, you send it over, like, okay, we're good, like, see you when this is real. And we'll deal with it, kind of kick it down the road. And that's exactly what you were talking about, where it's like, if you kick it down the road too much, like the legal work does stack up. Like the dilution, it's almost like too easy in some ways. But whereas the price rounds, I could see being a more institutional, like, we want share.
It's such a, like, I think founders underestimate how much work sometimes it is to clean up these caps. It's like you're putting off the legal, you're not like necessarily avoiding legal fees. You're just kind of putting them off.
Yeah.
Which is fine. Like maybe you're a mature business.
Which is the reason why the safe was invented. Or whatever, is because it's like, this company isn't even really a company yet. Like I can't spend this money on legal, but it's gotten abused, arguably. Like, okay, now you're a real company. You have multiple millions of dollars in the bank. You can spend, whatever, 10 grand, whatever, at like this price seed cost to do it the right way. And I think that just, as a feeling, it feels like it's swinging back a little bit in that direction, because there's just this weird world of safes that got put together where you don't know how many, like, what are the other safes are at. Like, a company could have raised, I raised it from this guy, or this guy from this guy, and now you get to the A and you found out that they actually screwed it up, or whatever. You've been diluted.
There's a lot of investors who are, so this is the messy part of the safe world now, because of the reason you just mentioned, which is safes don't really have any mechanism for you to tell other investors what's going on in that safe round.
Yeah.
Like the founder can say it, but they don't have to.
Yeah, no, they don't have to. They're siloed. It can be abused.
So there's a ton of pre-seed investors who we would term institutional pre-seed, because they are at a fund.
Mm-hmm.
And they are doing safe deals, but they are requiring a side letter alongside those safes. And so they're getting sort of quasi-priced round rights in a safe round. And the things that they ask for most frequently are things like MFN, most favored nation, pro rata, and information rights on the cap table. So MFN being, hey, you cannot give another safe investor a better deal than me. You have to give me that same deal. Pro rata, obviously, they can keep their percentage in the next couple rounds. And then information rights, like, what the heck is going on? Like, give me some sort of information about who's on the cap, maybe some basic financials, that kind of thing when it happens. And that's getting, pretty, like, these two worlds are melding. I mean, people avoid a price round because of the expense mostly, and the due diligence is annoying. But I think, I think two things. One, I think price may make a little bit of a comeback in 2024, and then two, I think this is actually the fascinating part. You and I have heard a ton of companies who are like, I'm just going to take in a little bit of capital, and I'm going to be revenue funded after that, and it's going to go amazing. Like, I'm not trying to go all the way through the venture rounds. I'm just trying to take in a little capital now.
Yeah.
If you do that on a safe and you never raise a price round, there is no automatic conversion mechanism.
Yeah.
You have to have that discussion with your investors of like, is the safe the right instrument to do just that little bit of fundraising on, or should it be a convertible note or something that at least has an interest rate and a maturity date, and like these investors are a little bit more on it? Because if you just raise on a safe and never raise a price, your investors don't ever have to convert into equity, which is pretty wild.
I know. I'm trying to think if I've heard, and I've definitely. Well, you want to know what? So as far as like what's kind of in vogue, and again, like I just listened to this podcast, so I've got like Sam Lesson in the back of my head. But like the cash flow, is way sexier today than it was a couple years ago, and a lot of talented tech people looking at the model and looking at they stay private forever, and there's liquidity issues and all of that stuff, and thinking to yourself, well, what do I do? Meanwhile, if you, depending on the timing of raise, you might be sitting on a safe that technically gives you that sort of optionality, but there's a lot of trust baked into a safe,
definitely,
like that you're touching on. That is like, yeah, we're not going to do legal work now, but you're going to have to do it when you raise the next one or you shut down. Where legally you don't have to. Legally, and I haven't heard of any ugly stories really about it yet, and about when it would happen or how it could happen. I think that the interesting part about it is like, is it worth it? Also, there's just a lot of trust in safes. There's a lot of but the thing that you're talking about, the souped up safe, is interesting.
Yeah,
like where it's like a safe plus a side letter that gives you price round kind of. So it's low legal, but like similar lock-in. Still,
and founders need to read that side letter closely, like really closely. Like at some point you do need a lawyer, probably even in a safe, if you have a side letter there that's like, hey, this is standard, or this isn't. You don't want to get into liquidation preferences or weird stuff that can happen there. So it's a messy world, and I do think the point that I think Sam and other people have made well is just that so much of venture is just trust. Like even pro rata rights. If you have the legal ability to pro rata, but the founder doesn't like you that much as the investor, like you're gonna take that founder.
You're gonna force it. Yeah.
You kidding me? Like it's all about it's such a relationship business, and you not just the relationship between an individual founder and an individual investor, but like what is the signal? What is the reputation of this investor? It's so deeply important. So there's a lot of like, it may say that's legally, but are you going to enforce it stuff that happens?
Exactly. Yeah. No, and that's exactly what I was getting at. Where it's like there's things that are legal and illegal, and there's things that are like actionable. I won't get into the story, but I had a really ugly like founder breakup with my first business.
Yeah.
And there was like maybe 50 grand on the table or something like that like maybe it should be his, maybe it should be mine, blah, blah, blah.
Sure.
And I had this really it was my first time trying to interact with the legal system when it comes to startups in the ugly version. And I talked to a lawyer. And I ended up actually talking to a judge who I got connected to through the lawyer.
Wow.
And they were both like, you've got to do an expected outcome on this, right? Where it's like, you're going to spend this much money to actually get into it. And then you're going to spend this much money. And then there's a let's say there's a 50-50 chance of you winning. So the expected value, so let's say it's 50 grand, right? It's going to cost you 25 grand to actually get into this with this person.
Yeah.
Bunch of time, bunch of stress. And then there's a 50% chance that you win. So the expected outcome is actually 25K. So you're like, your equation is like, what's the point of this? And in startup world and in seed rounds, especially in like the really early stage of all this stuff, it's hard to make the expected value make sense in terms of what is legally enforceable or not, and like actually kind of getting into it. And then the final thing of it, with if it is legally enforceable, but you would be part of the expected value is the shares that you own in the company.
Yep.
So if you take a bat to the company, like you're screwing with yourself also, and like in the signal and stuff. So it turns into a situation where, exactly like you said, where pro rata rights, and this is actually topical as we head into YC, because that can be sometimes a conversation with founders of like, oh, can you get pro rata? Can you not get pro rata? What does that even mean?
I mean, YC's, I don't know if you want to get deep into the YC thing. I think maybe when they made that change to the economics of what joining YC actually means, I think it was a pretty big deal. Like, founders sign 2 safes when they get on YC, right? The 7% for 125, and then a second one that's just like the guarantee, like pro rata's in there. There's like a lot of stuff that make it pretty favorable for YC ownership. And like, look, the brand is unbelievable. Like, there's no brand like YC in the Valley. So in a lot of cases, I think it makes sense. But it does, every demo day, we go through the same stuff of like, these companies are raising at 25 million post, and they're just like 2 people in a garage. Like, and people like, as though that valuation cap is like somehow actually the intrinsic value of the business. It's like, no, this is supply and demand fund economic stuff. Like, this has very little to do with how much this company is worth right now.
Yeah. I haven't like done a longer piece about YC, because I've done a ton. It's the most investing that I've done in my short career as an investor is through these YC access funds. Right. The YC access fund was, the financial product that it offers. I say financial product to defer from fund, because when I think of fund, I think of, a little bit more art than science, a little bit, especially in the seed stage, compared to the financial product, which is like, we execute this basket. We create a basket for you. You can buy the basket, and that's ultimately what we did through YC access fund. But got a good view and ended up seeing and made this argument where a lot of people talk about YC, and I'm interested in the context of these numbers. People talk about YC as like, oh, they're too early for the valuation to get, and like, what is this YC premium and all this different stuff. And the way that I actually ended up looking at the numbers were the thing that it seems to do, and these numbers might go against it, but at least when I did the like kind of math on it, it makes it a seed stage company.
Yep.
Even though it's not from a timeline perspective, it accelerates in the purest form of the word, right? Like, you could be a 3-month-old company. You could be a 1.5-month-old company because you pivoted halfway through the batch. When you come out of demo day, you are a seed stage company. No company that graduates from YC is going to raise at a pre-seed, like, I'm like looking at these numbers really specifically, right? Like the 10 million versus, like, I would be very surprised if I see in this batch that I'll be investing into coming up, the next few weeks, and I'm starting to book those calls, and I haven't seen any valuations yet, but 15 to 20 is like is going to be like, someone's going to raise on, like, I would be very surprised if it wasn't 15 cap seed to 20 cap seed being like the where people are hanging.
I'd be absolutely stunned if you saw anything less than that.
Yeah, I never. This will be the 4th batch that I'm investing in.
Yep.
4th batch that I'm investing in. I don't think I've ever seen below 15. Maybe I saw 12.5 one time.
Right.
And it was, and I would have, and I think my advice to the founder might have been like,
bump that up.
You have to do that. Just do
You're
the
YC, dude. Yeah.
Like, it's okay. Like, it's like, everyone knows kind of what they're getting into here. Like, so within so when I look at this though, and maybe to put some context, because the other thing about this 7, what's the geographic spread? Because there's, in my mind, I was just on the phone with a founder from London who I love. Poor guy, just across the table from London, Europe Angels.
Totally.
Europe Angels, like, it's like, and I was joking with him that it moves from like your like Silicon Valley Angel / Silicon Valley VC, most price insensitive, whatever, like the inventors of the safe, like, let's do it. You move to the East Coast in New York, it's not as bad as it used to be, but a little bit more like finance types, a little bit more like maybe they want the price, or they want to push you down a little bit. They want to understand the model. Like, the West Coast like angel would never ask for a financial model. An East Coast angel might ask for a financial model. And then a European angel just wants to own 50% of the company or whatever it might like. But so when you think about this data, do you have a sense of the because this is global data? Do you guys weight it?
No, so
How do you guys go about
this is
it?
just US. Just
Just
US.
U.S. Okay,
But
but all over the U.S.
but
Like
the spread does matter. Yeah. So it's over indexed. I mean, I would need to go check through these last
yeah, yeah.
75. I would imagine that they're over indexed a little bit on the Valley in New York. In
Uh-huh.
general, across our early stage, um, if you just take pre-seed, so anything that's happening on safes or convertible notes before a priced round,
Yeah.
that on Carta is 35% Silicon Valley,
Okay.
and called another 10% or so New York, and then declining percentages for
Yeah.
Boston,
Well,
LA,
yeah.
et cetera, et cetera.
Yeah.
So, and are these numbers different in different places? They definitely are. Although I will say the difference between SF and New York is pretty minimal in many
Yeah.
cases. The difference between SF and Charlotte is
Yeah.
much higher.
Yeah.
And so when we did them regionally, we just break it up by census region. The West and the East are kind of pretty similar. The South is just a little bit behind that. And then there's actually a decent sized gap to the Midwest. The Midwest is like still running on different. So for instance, an angel round in the Midwest, if you're doing that at, what does it say in the sheet? It's got a $6 million valuation cap. Like
Yeah.
I'm sure investors in the Midwest are up in arms in that. And they say, we wouldn't invest over a 3 million, whatever.
Yeah.
So it's converging, but only very slowly. There still is a regional difference there.
Absolutely. And I mean, I think I even experienced in my own kind of founder or fundraising career of and this was what, 2017, 2018, when I was first fundraising. And even then, I think the New York SF spread was wider than it is now. Now it feels like much more similar and comparable or whatever. And I would guess that.
And some of that is
places
industry
like Miami
based.
and Austin are pretty similar as well, because you're interconnected, right? Like just because you're fundraising virtually more, you're in touch with VCs, and if you're not like exclusively fundraising in New York, in most cases, you're going to be like across the hub.
There's actually a really interesting analysis yet to be done, which I would love to do if I ever come up for air here, which is like what percentage of capital invested into local startups is local money by city, because I think that there's actually, and this is something that I saw from, I think it was Ascend, maybe it was a Seattle venture fund, where they were like 85% of the money invested into these Seattle companies is coming from outside of Seattle. And outside of Washington in many cases. It's true that you can start a company anywhere, but it's not true that all of these ecosystems have like very highly developed angel investing networks. It may just be that you're tapping the angels that live in Silicon Valley. But they're investing into Seattle or Austin or whatever.
I know. I wonder how much that happens, because I feel like Silicon Valley definitely imports a ton of money as like the hub for like whatever. It still is the leader in, like, when you think of venture, you think of Silicon Valley and Palo Alto and all that stuff, and a lot of money, a lot of foreign money, both inside the U.S. and outside the U.S. goes to and thinks of Silicon Valley as where you would go if you want to like deploy into this asset class. And then it creates also a situation where the locals, and it's almost like classic. It's like a classic gentrification story where like the locals, like, they really love it. It's a great town. Everyone moves in, and then the locals are like, "This isn't what I signed up. Like, this isn't the same. I'm gonna go like deploy money somewhere else."
Right. Exactly.
But yeah, no, I'll be interested, because I think when I see this and I look at that, the 12 million, and I don't know if these are actually the numbers, but I wouldn't be surprised if that ticks up. And maybe the difference, but like if that's for the whole U.S. on a median basis, that's going to tick up a little bit in SF. And then you add because maybe this is me making sense of the prices I'm about to pay in YC. I'm like, this is okay, right? Like I can make sense of this.
Totally, yeah.
It bumps up. It bumps up. No, but I'll have to report back. I'd be very surprised, and I think that they coach it, right? Like, and I think
they definitely do. And they're comparing, the YC database. I'm sure their YC database is fantastic, and they're using it to help coach founders through what those valuations.
What's the price? Because that's one of the hard, and that's why I think this data is so valuable, and why I'm excited to share it or whatever, and why I think a lot of people are always excited to share it, is because one of the question of like, okay, what do I raise at, and what can I look at? What can I look someone in the eye about and be like, this is just what people pay? Because it's
Totally.
not, and you mentioned it really early on. It's not based on anything to do with your business. It's got nothing to, like you
Nothing.
cannot back into it from a traction perspective. Like
Yes.
maybe you could be like, oh, they've got a ton of traction for a seed stage company, so it's going to be 20 or something like that. But really,
But then it comes down to the founder profile too. So
yeah,
those like traction things. Look, if you're a first-time founder, will you get pushback from a VC about your valuation cap based on traction and other things? Probably, right?
yeah.
But if you are a second-time repeat founder with a great exit, you're not getting pushback. They're like, how much? Of course, like, what do you want to raise at? So, and those numbers like are baked in. So the founder profile really stratifies the like level at which you sit within this pecking order negotiating leverage when you're trying to raise this money.
Yeah, the second time founder with an ex, I had a friend actually who just went through this, and I literally had that conversation with him of like, I see why, and I based it off of the numbers I saw at YC. I was like, YC company will raise at like a 15 to 20 if they're depending on like where they're at, whatever. Like just the first time YC founder, whatever. Like you get into the second time YC founder, second time, you could get into that 25, like 30, whatever. And he happens to have a couple of exits under his belt, like singles, doubles, like but definitely considerable, definitely like separating him. It's definitely not his first time, and I think he ended up at 30. But the part about it from a founder perspective too, when you're across the table from VCs and just general negotiation, you don't want to be a dick about it. Like you want to put like negotiation is so much about like if you're a robot or like that you can be like, oh, like the anchoring mechanism, just like say something really high, high, and then they'll mark you down. But the reality is that like if you're looking to partner with someone on a long-term basis, you have to be able to put out numbers that don't leave money on the table. You don't want to undersell yourself, but also aren't like you not valuing the way the number might make the other person. Like if you sit down with a seed stage investor, if you care about,
It's all about like what are you comfortable? Like what is it that you're trying? What feeling are you trying to inspire in this other person? Right?
Yeah, exactly.
Like where do you actually sit within the negotiating leverage of the current landscape? Because it's just so it's sad, but it's true. Like the investor has a little bit more leverage than they did 2 years ago, for sure. It's just the fact of life. If you're YC, you're YC, and it's a different kind of conversation. If you're not YC, if you're not highly credentialed or highly networked, like you're coming into those conversations at a disadvantage.
One of the interesting things, though, that I've also seen, I think we've seen it. Two things that come to mind. One is the founder of Rewind AI, whose name I'm forgetting and who I could look up really quick, but he was the founder of Optimizely.
Dan
Soroker.
Yeah.
I don't know how to. I'll tag him and he can correct us.
Yeah, that's my bad. If Dan, apologies for listening.
No, so he's done some really. He did two things that have been really interesting. He's done these like I don't know if you've seen this. It's like every once in a while it takes over Twitter where he's like doing this public raise.
Yeah, right? And he's like, "Hey, pay me money to talk to."
I signed up for one of those. I'm pretty sure I was one of the first people.
Gotta do it. I mean,
maybe I'll trade it out. I had the thought like, oh, maybe I could sell this to someone.
To me, it was very clearly too low. It was like, dude, charge like $1,000. Come on.
Hey. Hey, it was one of the most like, wow, maybe I am just like, and me and my friends joke that like being like a deal guy is like a sickness. Like when you talk about deal, it just like moves into conversation. Like friends that I've known since I was 14, and we're talking about like what's like deals. Like whether it's and like crypto did this to everybody, where all of a sudden everyone's talking about whatever's hot.
Financials like the only thing that we care about. Let's go.
Yeah. But I felt it when that came out. I was like, I literally thought I was like, well, that's just cheap. That's just a good deal. Like I don't even know if I should be talking to him, but I'm taking this deal. I'm taking this deal because it's too cheap. But anyway, the point that I'm making is that and I think YC does this a little bit too, which I think is probably the best way to go about it, which is interesting about seed stage and early stage investing, where you want to drive the demand up so that if you are able to, so like as demand drives up, you would think that price would also drive up, which generally happens. But then what Dan did, and what this other YC founder I'll bring up, where you actually don't want to go with the highest price. Like so Dan, I think he ended up raising his seed or Series A or whatever it was from NEA, which is not like a rogue choice, right? Like it's very much like a, great, tenured VC firm.
Right.
And he did it at a price, and he mentioned, I think he wrote up about it, that he raised at a price, he had gotten like $1 billion offer. Like he had a term sheet at $1 billion. And he did a deal with NEA, it must have been their A, but at like 350 or 300 or something like that. Like a considerable delta in like what he did. And I think that, and the other example I have is like the YC side, we just starting to have, to set calls with people. And this founder, it was like, there wasn't anything on his calendar that was working. So I was like, oh, hey, can we slip in a different time or something like that? And he's like, and he said, I have 86 calls scheduled, so I actually can't adjust.
Can't fit you in, man. Yeah, like what are you talking
for him? But it creates this. But there's an interesting dynamic, right, where it's like that won't necessarily drive for the good founders, which is what everyone wants to care about. It's not like the price will just because that person has 86 calls, just because Dan has unlimited calls for Rewind or whatever, doesn't mean that the price just drives up and to the right constantly. It actually seems to drive up and then plateau as demand continues up. Where it's like, again, if you're out of market, if you're a founder in Ohio or in the Midwest or something like that, and you have access to a very small amount of demand, your price is going to be low. You don't have much leverage. You go to the Valley. There's lots of demand for what the type of stuff that you're doing. Blocking out the actual traction company, all that stuff. But it does seem to plateau in most situations where, and then the best founders understand that I could raise my seed at whatever 100, but that puts me in a kind of a weird spot considering what I want to do, what many want to raise in the future, like the kind of path people go down, which is, and I guess maybe that segues a little bit into when you look back, and you've been in this chair for Carta for a while now. How long has it been at Carta now?
3 years now. Yeah.
3 years. In a wild 3 years.
Dude. Definitely joined in the very early 21. So we've seen some cycles. I feel old and grizzled, man. Yeah.
Yeah. A lot of gray hair on the data team at Carta. Are these numbers right? Are these? It's like,
it's a lot.
So maybe give me a little try to put 20, this Q1 20 or 2024 cheat sheet in context of from the beginning of your time to, and we don't have to pull exact numbers, but when you think of kind of the flow of where these medians have been, what comes to mind?
I mean, I think two things. First off, the SAFE, even though it was invented in the mid-teens, 20-teens, it really took off in prominence during the pandemic, and it established itself as the default mechanism for early stage fundraising. Even insofar as you look back to 2019, it was still convertible notes were about 50% of it, and now it's 85% go through safes. So safes dominate now in a way they didn't, which changes the dynamics of things. I will say that if you just look at seed rounds as an indicator, late 2018, early 2019, the median seed round pre-money valuation on Carta was something like $8 million, and now it's 13. Are the seed round companies 5 years later double intrinsically valued? Probably not. Most of what is happening there, I think, is twofold. So one, it's the economics question, the fund economics questions, we need to own a certain percentage of this fund. And if, as has happened, there's a lot more bigger seed funds around than there used to be, then their check sizes are bigger, so their economics dictate a slightly higher valuation. That's one thing. Two, boom times in seed stage and pre-seed fundraising in 21, fewer companies getting funded now. Not, I would still say relatively a robust amount of companies getting funded. It just feels very bad because
comparatively,
how crazy it was in 21. But those companies that are getting funded right now, I think if you just compared the median on things like traction and whatever, the companies that are getting funded now just have more of it than the companies that are getting funded 2 years ago, for sure. Looks different in different industries, but it's the biggest changes are the quality of the companies is up. The valuations, if you're a seed stage investor that's waiting for valuations to go down, good luck. I just don't see that happening. There's two, not because you may be right about the intrinsic value of these companies, but the supply and demand is off.
Got it. Yeah.
Especially for the hottest rounds.
Yeah.
the competition is super high. People want to invest at the early stage. They don't want to get close to the IPO market right now. That thing is shut. So it's a tough time if you're a small seed stage investor who's like super focused on where like your entry point. It's probably a tougher market.
So, and I think that the first time you put some data out about that, I'm trying to think about when it was. Maybe it was, I don't know, 6 months ago or even a year ago, where that general headline of prices are down a little, but really it's the number of companies getting funded that got cut heavy.
Yep.
Where they're a lot more, and I think it became about, and I don't, you can say more discerning or more like if we're going to look really negatively at what happened in 2021 or whatever, but of the headline being that the prices didn't change that much, but a lot less was getting done, and therefore that created this feeling in the market of like, oh, it's harder. It's like, and that's an interesting, again, kind of look at, and this started the thing I was talking about where the graph of demand versus price, is linear until it isn't. Like they correlate until it plateaus. And similar in this situation where like, as the macro and maybe demand at the macro level goes down, maybe valuations go down a little bit, but then it's actually going to plateau, and the price is going to plateau, and value is going to value is going to stay the same, and volume is going to continue to decrease in line with.
I would say that, if we go back to, I'm sure Sam, I don't think this is Sam Lesson's point. I think, Sachs and others have made this a lot of, like, this is a craft business. This is there are only so many venture backable ideas and startups at any one time. So the two points there would be, one, if that's true, then like the fact that there's so much more competition in the seed stage is a function of people coming down from the top of the market. And that's the soft banks and the Tiger Globals, they went away. They're just not interested in venture that much anymore. But if you were doing Series A and B, well, seed might look really attractive to you right now, right? Yeah. You're like moving a little bit earlier and earlier. There are only so many ideas. Now, maybe as we open up more, like geographies, get a lot more venture ecosystem like entrenched and whatever, there'll be more ideas. But I still think I think Namdi at Lightspeed actually is a really good source on this. She's like pounding the drum is like, there aren't actually that more venture backable companies being made than there used to be. So you're fighting for those super high return fund returners. The competition is going to be pretty high. And so the entry points are never going to get that low. And I think that dynamic, venture is just it's like a way more mature asset class than it used to be.
Yeah, but in the flip side, it's more mature, but then some constants have remained. Like it's like all this money is flooded in, but that number of like how many standout founders or how many standout ideas are there hasn't increased in line. So VCs, you could argue, has gotten harder for that reason. And I think Sam used the word artisanal as far as, similar, again, obviously like craft is called craft.
It's beautiful. We love it.
Exactly. And then there was another thing that comes to mind actually, that Jeff Lewis from Bedrock, who is the former founder, like that, he does the temp check video, which I'm a huge fan of, and he's been really great. Or he's done a lot. He's like more of a Series B guy, I think, Series A. Series B. But he mentioned it on the VC side that like there's only, at any given point, there's only like 10 to 15 VCs that really matter and that really like drive returns. And I had another friend who mentioned the same sort of number and claims it wasn't based off of that, but whatever. And it's just, that number is like the argument is that number has remained constant. And that number is built off of the founder number, right? Like if there's only X number of like meaningful VCs, those X number of meaningful VCs can only have Y number of relationships that are meaningful, right? Like you can't know everyone. You can't be close to every founder all the time. Like it just doesn't, there's just almost only so much time in the day for what is, again, an artisanal, like, can you scale yourself in VC?
So that points to two things, which is it's a conversation I've actually been having with a bunch of people here internally. So hypothetical experiment, all of the noise about AI radically changing the cost basis for these startups, and Sam Altman's dream of having $1 billion valuation company with one employee. So, okay, say that all comes true, or at least becomes more and more true.
Yeah.
What do the Series B and C investors do? Why would I need a 10 to $15 million check? I don't need it.
Yeah.
And if that's true for a lot of venture, then two things happen. One, those investors go earlier, right?
Yeah.
Because they've raised the funds, like they're gonna try to invest it. Maybe some of them give it back, but very few. So they go earlier, so competition is higher at the earlier stages, or they go super late and they say like we're gonna invest, basically private equity kind of values and ideas around taking companies to public, but there's like a hollowing out of the middle part of the venture market that is possible if company building radically changes from you need this many employees at this unit of ARR to AI makes it possible to have everybody can be Instagram and have 10 employees and get bought for $1 billion.
It's a super interesting storyline that I definitely think about a lot, and I because you want to know why I think about it a lot, because I think as a newer investor, right, as like a younger investor, it's like, oh, who am I gonna be? Who do you want to, like, if you're ambitious,
right?
Like, you're gonna invest other people's money, you want to do it well, you want to, like, have a craft of some, like, do you go and be like, oh, I'm gonna be these other you're gonna be Sequoia? How would I beat Sequoia at the game they invented, right? How does that work?
Yeah.
But I think that one thing that I think is really interesting from both the people on the building side early stage in their career and people on the investing side early stage in their career is that the technology seems to be progressing faster than the financing can shift. If you're a big fund, those funds are raised and deployed over the timelines on those things are crazy. It's built in, like, the way a pension fund investing into a Series B fund that deploys over a 4 to 5 year period into an X number, whatever. Like, those timelines are insane compared to this world of AI that we're living in, right? Where it's like, it seems like software and the ability to build software is changing fundamentally on like a day-to-day basis.
Yeah.
And so that changes really fast, but the financing just simply cannot, they can't steer the ship that fast. It creates a power vacuum in what could be a new market. And I think that people who kept their funds reasonably small can be nimble, right? The same lessons in the world or whatever, but not to call it Andreessen, the people who birthed us here at Sandhill at one point, but it's a big ship to steer in a different direction. So,
and they're playing different games, right? So the AUM game versus the DPI game, like, I get it. It's a radically different way to set up funds. It makes sense. The real question is like, if they really believe in the AI revolution is going to materially impact and decrease the amount of capital it takes to get to a venture scale outcome, then we have too much capital.
Yeah.
So, like,
what happens? Yeah.
Hundreds of billions of dollars in dry powder. Like, where is it going to go if the company's like, we don't need it? And I don't think this is like a little bit tongue in cheek. I'm kind of skeptical as to when the boom times come back, guess who's going to be totally out there fundraising? It's like all the founder. Like, we go through this, right? Capital efficiency is amazing right now, but will it always be amazing? Like, that's a good question. But if it's true for even 25% of the new companies, then it does change the way that venture works.
I think we both have to go, but the last thing and something that maybe we have to talk again soon, because this has been really great, but I'm really interested, and I think it happened at the IPO level, and I'm wondering how, like, what is the signal associated with? So I actually think that there's arguably some negative signal associated with IPOing, because it almost implies that you don't have private market availability. Like, some of the best private market, the SpaceXs of the world are like, oh, we don't need you. Actually, we have unlimited private money. Why would I do that? And so it creates this like, oh, well, people go public because they have to go public, which is a horrible signal. And I wonder if that could happen in the early stage where it's like, oh, you're fundraising? Like, lame. Right? Where it's like, it's been sexy. It's been sexy for a decade. It's been sexy for 2 decades. And now all of a sudden it's like, oh, really? Like, you had to, it's almost like debt. Like, oh, you had to, like, get a lot of debt. Like, you don't want to talk about it, right? Like, if you're underwater because you loaded up on debt for whatever reason,
dude, that's
probably not like, look at me, I did it.
That's a fascinating idea. The idea that an IPO is a negative signal is, I like, totally, as you said, it logically makes sense, and is also like kind of a flashing warning sign.
Yeah.
Like that's not good, right? Like
No, it's really weird.
Like you guys got to change something.
It's
like,
a really weird world. It's a really weird world.
Like, I get it. Yeah, if you're Stripe or SpaceX, you need to IPO only to satisfy your employees. But if you can do the secondary stuff, and there's satisfied anyways,
thing, SpaceX attracts and retains great employees. On regular tenders.
Right? Every 18 months, 2 years, we'll do a secondary tender offer.
Less twice a year. I think that you could get liquidity.
Yeah, it's
a good day. It's a good day to be Carta, maybe. More liquidity for the Carta side.
But then that points to like, if that's true and people just don't go public, which they haven't been for the last year and a half, at some point, the regulators are going to look at this and be like, we have to push people public. Like they will not just sit back and let it happen.
You're right. I think part of my thesis on it actually is, thesis is a big word for what I'm talking about, but like
the thing that I thought about in the shower
is that I don't think I'd bet on the regulators figuring that out. I would bet on the private markets getting more accessible before the public market regulators are like, well, actually, let's like make it easier for people to go public. Like, So hey,
make it easier or force people to. Those are different things.
Force people to. Yeah, that'd be an interesting. Like, you dragged IPO, like they're ringing the bell, like they're pissed about it. Like, fucking guys, you got me.
That's good. Yeah.
Hey, let's talk again soon, and I'll cut it up. I'll share a recording and stuff before we go, before it all goes live. But this has been great.
It's cool about it. Good to talk, man.
Hey, man.